From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, hot jobs and higher wages. It's pushing yields higher and volatility back into the bond market, while hopes for a March rate cut are disappearing. But we begin with the big issue, an upside payroll surprise.
Wow. I mean, what an amazing jobs report.
This is a very strong report and a strong labor market.
The economy is really strong.
This means March is off the table.
The Fed is now thinking that March is going to be too soon.
It was a reality check.
The market actually hadn't been listening to Powell.
The market got super overzealous.
The market did get carried away.
Powell is still sounding very cautious.
He was right to be a little bit more hesitant.
For the time being, with activity still resilient, it makes sense to err on the side of caution.
All inflation needs to do is do what it's been doing, and they're going to start cutting.
It's wait and watch the data, see how that comes through.
Chair Powell's really trying to buy time.
They can hold off. They can wait and see.
I worry that the Fed is going to kind of just not move and wait until something really unravels in the job market.
And on the back of that jobs report, you do have the market dramatically repricing. Just take a look at the 2-year yield alone. By 1 p.m. on Friday, you saw it shot up about 20 basis points. And not only is it a lot higher on the day, you're looking at nearly a full round trip in that 2-year yield since the beginning of the month. In over a 30-day time frame, you do have the 2-year above 7 basis points higher in that time. So not only is the market recalibrating their expectations for when that cut might happen, we have pricing moving around in real time. I want to flip up the board here because there are some ramifications for this higher for longer thinking. And this is where you see it in credit spreads. This is a broader metric here on health, and we're looking at the global credit spreads across indices really widening the most this week since you've seen back in October. And you see it on the heels of other stresses in the market. For example, here, the white line is tied more closely to the financial industry. And of course, this week, you've seen a hop up, a widening of spreads here when you saw some concerns around New York Community Bank and credit quality tied to the commercial real estate sector. Now, the question is, are there other sectors that will be more immune to that higher for longer dynamic? But for now, even before today's jobs report, Fed Chair Jay Powell was signaling caution on cutting rates.
Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen.
Joining us now, Debbie Cunningham of Federated, Hermes, and Pimco's Tiffany Wilding. Tiffany, when you look at the volatility just in the 2-year alone, let alone along the curve, how much risk is there still in short end rates?
Yeah, well, in our recent Outlook piece for 2024, we titled it Navigating the Descent because, inflation has come down quite a bit from peak levels. Eventually, the Federal Reserve and other central banks will be cutting. But, the path to getting there and then ultimately, the pace thereafter is probably going to be a bumpy road. And I think that the recent volatility that you've seen in the front end is a clear example of that.
Deborah, how do you think about even moving along the curve here? Because you saw just a couple days ago the 5-year really take a drastic leg down in terms of yields. You were seeing a huge bid into that 5-year portion of the curve. Is that still a place you would be buying, or how much risk do you see as you start to move along in duration?
I think there's more risk than the market is willing to accept at this point. And I agree with Tiffany. And ultimately what that means is volatility is going to continue to abound. I'm not quite sure why the market rallied post the FOMC this week. I mean, Chair Powell seemed very clear. March was off the table. And now the numbers that support that from an economic perspective are coming to fruition. And so finally, the market it's like getting, cold water thrown on it. But quite honestly, I think it was overzealous for a good portion of the month of January already. And my expectations would be for the rest of this quarter and probably even the rest of the first half, you're going to see some ups and downs that are pretty substantial in the market.
Well, Deborah, double down there. How do you navigate? Where do you buy or sell to position for that reality?
Well, I think you have to look at the time frame. If you're looking at true cash, things that you need from an operating basis today, tomorrow, next week, that stays in short-term securities, that stays in money market funds, that stays in very liquid, available funds on a given day without really principal risk associated with them. If you're talking about something from a strategic or a core cash basis that will likely not be needed till maybe the end of this year, the second half at some point, or maybe even into 2025, then I think you're very safe navigating out into, you know, the next aspects of the curve, whether it's micro short, ultra short, you know, 1 to 2 year type of space. But I wouldn't do it with cash that you are worried about from a principal perspective over the next couple months.
When you think, Tiffany, just about how shocking and conflicting some of the data has been, just how strong jobs have been just today alone in its report, do you reposition to capitalize on the direction of travel here as market expectations change?
Well, so I think that, you know, any good risk manager has to think in terms of scenario planning. You know, and although, you know, the rhetoric has certainly been that a soft landing, the probability of that is increased, and we don't necessarily disagree with that. Chair Powell himself even said that the balance of risks are looking more balanced, you know, but nevertheless, there's still risks out there. You know, and I think the fact that growth in the United States has been so strong, you know, relative to its past history in the second half of this year, but also relative to its developed market peers, which have really stagnated. And you're still seeing very strong trends within the labor market, a labor market that's even maybe inflecting a little bit higher here, then you have to be a little bit worried that inflation could reaccelerate. Now, of course, in 2023, you had good supply side news that resulted in inflation coming down despite all that demand that we had. But that might not be the case in 2024. As we've argued, you know, you can't go to heaven twice. I mean, those supply side gains might have kind of run their course. So I think you have to be cognizant of reacceleration risks. But of course, on the other side of that, you know, the issues with New York Community Bank and obviously what we know in CRE markets, you know, you have to be cognizant of those downside risks as well.
Debbie, follow up here on this idea of a reacceleration of inflation. It's not just hot jobs, it's wages too. How much does that pose a risk into the coming months as the market recalibrates any potential for a rate cut?
I think wage inflation, I think housing inflation, you know, those are things that continue to run very hot. They've come down. The acceleration has certainly slowed, but they're still rising. They're not decelerating at this point. And I think there is substantial concerns that those will offset, you know, what have been gains from an energy sector, from a supply side perspective in 2023 as we go out, you know, into the first half of 2024, and the reacceleration is quite possible. I think, you know, the confidence level that Chair Powell continued to emphasize at his press conference this week needs to be addressed.
You just think about the recalibration of expectations, not just about a March rate cut, the idea pretty much going away in markets. Even a May cut, you had the odds drop from more than 90% down to about 66, 65% in the market today. How likely do you think, Tiffany, a May cut will be at this point?
Yeah, well, look, I mean, I think the thing that we've been saying is that, you know, we always thought a March was a little bit too early. But nevertheless, you know, there's a lot of data between now and May. We do think inflation will continue to, like, on a year-over-year basis, decelerate. We'll think it get into that 2-point-something zone that we think the Fed would be eventually comfortable with cuts. So taking everything into consideration, our baseline view is still that kind of mid-year is still a reasonable expectation, which is consistent with where we think that Federal Reserve officials are at this point. You know, and then kind of a every other meeting type of pace after that, you know, is kind of reasonable. But as I suggested, you know, as I emphasized, you know, I mean, there's certainly scenarios on either side of that case. You know, it's something that the markets are going to be trading. Markets are all about the balance of risks, not just the baseline. So as I mentioned, navigating from here until May will probably not be an easy journey. But, you know, for right now, at least that's our kind of baseline is more of a mid-year type of kind of a June timeframe.
There was a lot of discussion about cuts, but Debbie, there's also a question about the Fed's own balance sheet, what it looks like, the impact on markets. How much will the Fed be able to take their gas off the quantitative easing cycle into more of the quantitative tightening before you would see any type of a tantrum, rather?
I'm not sure that it would be considered quantitative tightening just to take to reduce the amount. If you look back at when the process began, they kind of ramped it up over the course of 6 months. There's the likely potential and possibility, I think, that they do the same thing on the downside. I think the fact that it was emphasized that they really haven't had the discussion on QT yet, that they would be looking at the March meeting for a more fulsome, overview of how it was impacting the market and whether or not it truly was having any kind of impact on the liquidity in the Treasury markets. Certainly that would be at odds to what they're, looking to achieve. I think we're looking at something that is a first half, maybe beginning of second half item, but I don't think it's something that is going to happen, with immediacy.
How do you think, Tiffany, that this would start to impact the market? We're already seeing this push-pull between tighter and looser financial conditions. But if you think about tightening and the way that it could impact the banking system, you yourself mentioned New York Community Bank earlier. Are there more strains to be had with the advent of a tightening cycle?
Well, I certainly think so. Our kind of take on the community bank issue is that they were under reserved for the potential losses that could occur within their CRE portfolio, and they wanted to shore that up. I certainly think there are other smaller regional banks that are also probably under reserved. So this is probably not the first piece of bad news that we could get. On the regional banking sector. So I think you have to be cognizant of those kind of risks. We know that there's a recession happening within the CRE market, within the office market, but it's just the question of the kind of broader spillovers into the economy, which we think will be manageable because many of these banks, those properties are still paying and they are not, they don't have to mark to market unless they have to, to roll over the debt. So I guess overall what we would say is that, from that perspective, certainly we could see a little bit tighter financial conditions. We think it's going to be manageable. On the QT angle, the thing I would emphasize really 2 points. The first one is the Fed, I think, has been very clear that even if they start cutting interest rates, they could still continue QT because it's normalizing the balance sheet and they would be normalizing interest rates back to a neutral level. So they're normalizing both things. The second thing on QT that I would just highlight is that it's interesting to me that people are talking and so focused on tapering when you look at reserve levels, bank reserve levels, they actually haven't tightened at all, really, despite the fact that the Fed's reducing its balance sheet because it's all come out of the RRP. So I think there's more that the Fed can do here. Maybe they do it a little bit more slowly, but my expectation would be that they're not. QT is going to continue at least throughout this year.
More risks ahead to keep an eye out for. Debbie Cunningham of Federated, Hermes, and Tiffany Wilding of Pimco. We thank you so very much for your time. Up next, the auction block. IBM is helping to drive U.S. high-grade issuance to a record month, and we're still watching those yields soar. We'll keep an eye on it all. Stick with us. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, where just like the jobs report, issuance is still red hot. In Europe, January was a record-beating month, with borrowers selling more than 350 billion euros in new debt. Sovereigns led the way with large deals from Italy, Spain, and Germany. And here in the United States, blue-chip firms sold nearly 190 billion of bonds in January, and it set a new record for the month. IBM, Capital One, and Kinder Morgan fueled sales this week. And over in high yield, volume stood at over 31 billion, and it was the busiest month since September of 2021, and it was the busiest January in 3 years. Sticking with credit, BlackRock's Jeffrey Rosenberg sees opportunities off the back of the Fed's decision.
The credit markets, despite some of the news today in terms of the banking sector, that's particular to commercial real estate. And that is something I think we have to keep an eye on. But you look at the corporate side, you look at the consumer side, it's very strong. And the credit markets here, I think, are strong. There's not a huge price appreciation opportunity, but I think the yield opportunity that you can capture there without the risk of the downside of of recession is still the story here.
That's it. Bring in Gene Tannuzzo of Columbia Threadneedle and Bank of America's Matt Dzok. Listen, guys, you have a time where people are pouring into credit. Clearly, issuance has been very hot, but you are seeing spreads globally starting to widen just a bit. And what was fascinating to me is just how much they widened this week, off the back also of some strains really starting to be seen in the financial sector. Gene, where's the risk hidden?
Yeah, I think it's a good point, but I think what the widening that you're referring to, Sonali, is really more a bit of a correction from what happened in the fourth quarter and the absolutely tremendous rally that we had. And in a bigger picture sense, there's a tug of war going on between yields, which are elevated, and spreads, which have been continuing to tighten. And in the end, yields are winning. We're seeing continued strong demand, particularly from liability matchers like pension funds and insurance companies for the long end of the curve. And I think, strong economic environment like we saw with the data this morning, that's poised to continue.
How do you think about it, Matt, when you see kind of high yield markets and even leveraged finance markets trying so hard to break open? How much risk would you be willing to take on?
So we're not looking to take excessive risk at the moment. But at the same time, to be fair, we're very focused in the economy. Our tactical asset allocation decisions are primarily based on where do we think we are in the business cycle. And again, Chair Powell and FOMC delivered a very important pivot this week. Not the pivot people are talking about, the pivot towards rate cuts and slowing the balance sheet. That was all known. One of the important pivots that Chair Powell made this week was they said, strong growth, a strong labor market, we welcome that. We think we can get disinflation without causing any pain in the economy. That's a very different message from 2023, where they're telling us, listen, we want to bring inflation down, and that might cause a pain. That's an important pivot. And so if we think back to some episodes of soft landings, I'm thinking mostly about the mid-1990s. Yes, our credit spread's a little bit tighter than you expect right now. Are they pricing a lot of risk? No. And to be fair, we are slightly underweight investment grade credit and slightly underweight high yield at the moment, but that doesn't mean we see a widening opportunity anytime soon. In the mid-90s, when the Fed correctly pivoted, fine-tuned rates, they kept the economic expansion going, and credit spreads stayed tight for several years thereafter.
Matt, I get the point you're making here, and Gene was kind of making it here too. The question I have, even if you believe that yields are paying you, Gene, are spreads really telling a story of not getting compensated enough for the risk you're taking on?
You're asking the right question, and I think spreads are telling us something about the rear view mirror right now. So a year ago, most economists were calling for a recession at some point in 2023. We did not have that. We had a soft landing for the last 12 months, and that's what spreads reflect. I think on a go-forward basis, we do need to be a bit more careful. It's not to say that there was anything wrong with the labor market in this morning's report. In fact, the current period data look pretty good, but we're not being paid a lot. And if we look specifically at certain areas of the market, like long-duration industrial bonds, they're not just the tightest in the last 6 months, they're the tightest in the last 20 years. But there's tremendous dispersion, and I think dispersion is the key here to be able to navigate. You mentioned concerns in the banking sector. That's true perhaps on a micro level, but if you look at a bigger picture, what we see is larger banks, those systemically important banks, in a tremendous position from a credit perspective to navigate the new Basel III regulatory environment. And they're trading exceptionally cheap relative to those longer dated industrial bonds. Similarly, industry by industry, sector by sector, company by company, the dispersion is remaining pretty large. So I think that risk premium is not particularly attractive on the whole, but there are opportunities within it for sure.
How much idiosyncratic risk is there, Matt? Just today, we have reported here at Bloomberg that there was a $1.7 billion leverage loan deal pulled in the market. Yes, that's tied to a specific deal, but again, the leverage finance markets are trying to break back open. Is there too much risk there still, you think?
Again, we don't see a lot of tremendous credit risk at the moment. Again, we agree with what Gene's saying. Sonali, we agree with the points you're making as well. Spreads and valuations are slightly tight for us at the moment. And again, we are slightly underweight, both investment grade and high yield, based on those valuations. But at the same time, you were talking about the record issuance. That record issuance is on the back of record demand. There's tremendous demand for fixed income right now. So again, although we were cautious on the economy, we're getting a little bit more bullish on the macro environment. And so while we would welcome some widening to take advantage of that, I'm not sure we're going to see that anytime soon. Now, the trouble becomes, and again, we are slight underweight. You get about approximately 1% extra on investor-grade corporate bonds now than you do versus treasuries, right? Over time, in a diversified portfolio, on average, per Moody's Investors Research, you only get about 5 basis points of credit losses. So as we all know, the majority of the premium you get on a diversified corporate bond portfolio is not for credit risk. It's for that liquidity risk. So while we're slight underweight, the longer you hold that slight underweight, the less yield and liquidity premium you get in a portfolio, it will reduce over time. So we're very carefully and prudently and slightly underweight there.
Gene Tannuzzo and Matt Dizak, thank you so much for your time. Wall Street hoping for another record month of issuance. We'll keep an eye on it. Still ahead, the final spread. The week ahead, investors are bracing for a host of Fed speak all around. Stick with us. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the final spread. The week ahead, coming up on Monday, we have the Fed's Bank Lending Survey, now a closely watched event, plus the latest U.S. Services PMI and ISM Services Index. And Tuesday, earnings continue to roll out, and Thursday, all eyes will be on Treasury Secretary Janet Yellen testifying in the Senate. And finally, Friday, we get U.S. CPI revisions. And for my final thought, let's look at all of the Fed speak coming up next week. A lot of people setting out to read the tea leaves. Atlanta Fed President Raphael Bostic kicks it all off on Monday, followed by Loretta Mester and Neil Kashkari and Harker and Collins on Tuesday, Kluger, Barkin, and Bowman later in the week. Just a very busy week ahead, and a lot of divergence on what we might see in terms of expectations for rate cuts, for quantitative tightening, and the impacts on the market all around, especially that banking system where we're starting to see some fragilities once again. And remember, this all comes after we've seen a round trip in 2-year yields, 20 basis points higher on the day. A lot of economic data ahead from New York. That does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.